Hello, this is MeTime Television exploring United States stocks. The United States Blue Chip Stock Analysis segment is being broadcast simultaneously on our channel, MeTime Television, in partnership with MeJune Television. The Blue Chip Stock Analysis segment we'll be covering together today is about a company called Intuit. Its ticker symbol is INTU. This Blue Chip Stock Analysis segment isn't meant to suggest that you should buy just because it's a blue chip stock. This segment is based on data where we look at the current situation and point out the company's business model and risks. So just because this stock is featured, I hope you don't think you have to buy it right now. This doesn't guarantee that the company's stock price will rise in the future either. We analyze stocks and companies using data. So when you analyze other companies in the future, it would be helpful if you know which data to focus on and how to interpret that data, so that you can develop the ability to discover and invest on your own. Today we're going to talk about Intuit, a company that provides financial management and tax management services to the general public. First, let's take a look at the recent stock price trends, and then I'll go over 4 areas using data. If you look at Intuit's stock price, this is the movement over the past year. It stayed almost flat for a year, and then there was a sudden drop. So the stock price, which was trading around $700, dropped to about $530. That's roughly a 40% drop, and honestly, it happened without any particular reason. Of course, after the end of the year, especially after December, the overall index dropped, so Intuit couldn't avoid it either. Other than that impact, there weren't any other news or factors that affected it. So the stock price dropped, and then as the index recovered a bit, the stock price went up. If you look in the middle here, you can see there's a gap around the $650 to $700 or $750 range. There's a hole in between, and the stock price shot up completely. We usually call these gaps, and when the price rises like this, we call it a gap up. When there's a sudden drop and a hole appears, we usually call that a gap down. So in the case of this company, there was a gap up here with a sharp rise. And then after that surge, it's been going through what's called a period of consolidation. After a sharp rise, the price doesn't go up much further, but goes through a period of correction. When there's a big surge, a lot of people want to sell their stocks to lock in their profits. So we call the period when those people sell off their shares and the market absorbs that supply a period of consolidation. Right now, it looks like the stock is in a consolidation phase after the sharp rise. So far, it's not showing any signs of a sharp drop or anything like that. Compared to the recent low, it's up about 45%. So why did it gap up at that time? What kind of event made it shoot up like a rocket booster? It was because there was an earnings announcement. When they announced their earnings, the sales and other figures came out much better than expected. As the market saw an earnings surprise, the stock price jumped in a single day. So honestly, unless you bought it beforehand, there probably isn't much difference between the price now and the price after the jump. Alright, then let's take a look at them one by one. This is an overview of Intuit. On one side, I'm covering the key points and risks for you. This company has several business divisions. The first is services for small businesses, such as handling accounting or payroll and managing accounting, financial information, and taxes on their behalf. The first business division offers accounting and payroll outsourcing services and also provides a platform where clients can manage things like inventory. The second one is a service that handles tax filing on behalf of individuals, although it's not limited to just individuals. And the third is a service that recommends financial products like loans based on artificial intelligence and earns commissions from those recommendations. So these 3, especially the ones at the end, are part of a business division called Credit Karma. It seems a bit different from the one above, though. Anyway, it's a company that uses technology and technical solutions through its platform to solve certain services. So if you go to the company's website, you'll see screens like this. They describe themselves as a global financial technology platform. We are a global financial technology platform, so we'll provide you with a platform that helps your company grow rapidly. You should focus on making money, that's what they're saying. If you look here, there's a service called TurboTax, and as the name suggests, it's related to taxes. Next is QuickBooks. When we say books, it usually refers to financial statements. So, QuickBooks provides accounting and payroll services for small businesses, TurboTax handles tax services, and then there's Credit Karma. Credit usually means credit or trustworthiness. So, they let you check and manage your credit score for free, but there are a lot of paid services included as well. As you use it, you'll notice that there are many similar services in our country too. For example, Credit Karma earns commissions by recommending financial products or arranging loans for users. Lastly, there's MailChimp, which might seem a bit out of place. It's also widely used in our country, in Korea. So if you try to create an email solution that sends emails on your behalf, it actually takes quite a lot of time to develop that as well. So in the case of Yongin, they charge per email sent, so it's simply a service that sends emails on your behalf. So, although it's a bit different in nature, it's still included in the business sector. As far as I know, it's counted as revenue included in QuickBooks. And they also provide a service called MailChimp that handles email services on your behalf. So they provide these kinds of services, and broadly speaking, there are three main ones. Looking at the business sectors, the QuickBooks segment accounts for 37%, making it the largest part of their business. Next, TurboTax, which is a tax filing service, makes up 27%, and then the Credit Karma segment has the lowest revenue share at 11%. What we should pay attention to is that among the current business segments, this is the fastest growing segment. So you can understand that the current growth engine lies significantly in Credit Karma, and that's how you should look at the business segments. Let me talk about the risks. The risk for this company is similar to a case we've seen in Korea. In the United States, the Internal Revenue Service introduced its own free tax filing system called Direct File in 2024. In the past, individuals used services like TurboTax or Intuit to file their taxes. Of course, when you go in, they say everything is free, but at some crucial point you end up having to pay. So they used to make money from that. But in 2014, the Internal Revenue Service created a direct file service and launched its own free filing system. That's right, so just like in our country, you can file your taxes directly on the Internal Revenue Service website. Then, if people who used to pay for private tax filing services start using the free service from the Internal Revenue Service, it would definitely hurt the revenue of those companies. This is one of the risks. In 2025, the budget for ISDF has been expanded. And when private companies provide tax filing services, if they charge a fee, they're required to disclose it. With these kinds of requirements, there are now significant legal regulations. So for business areas like TurboTax, these kinds of risks have arisen. However, so far, it hasn't reached the point where it seriously affects Intuit. It's a risk factor, and regarding this, there are some arguments being made. Then the taxpayer, the person who has to pay taxes, and the person who imposes the taxes actually have different interests. The people imposing the taxes anyway would want to impose as much as possible, and the taxpayers want to save as much as they can. But the National Tax Service not only imposes taxes but also receives tax filings. It seems that the interests are interpreting these points as a defense and promoting them in that way. If you look at our country, there was a big event called 3-3. In relation to the National Tax Service's tax refunds, they offered to refund these taxes for free and actually provided a lot of tax refunds for free. As a result, these filings to the National Tax Service, which are called amended returns, increased tremendously and the workload at the National Tax Service became enormous. Because once you file an amended return, they have to check whether it's correct or not. In the past, there were large amounts, but these days even individuals file for 50,000 or 100,000 won. As I mentioned earlier, there are companies like Samsung, and although there are others, Samsung was the most representative. If you go through them, the National Tax Service has to assign personnel to keep responding to these cases. Whether this is right or wrong, because of that, the number of cases has increased a lot. So this time, when filing comprehensive income tax on home tax, they made it much more convenient. If you click on the refund amount, it comes out right away. So that's why I'm a bit puzzled too. The National Tax Service told me to pay, but when I click on the refund, it tells me the refund amount. So did they really do their best to give me the correct refund amount? I have a lot of thoughts, like it's convenient, but it seems like all these complicated situations are happening right now. So, rather than the issues happening in our country right now, these kinds of systems are already being introduced in the United States as things like Intuit. So I'm not sure which direction things will go. So the risk factor lies in this aspect. Other than that, I don't really see any particular risks in business areas like Chris Karma or QuickVic yet. And it's also a company that's quite ahead in terms of market competitiveness. Because it's a leading company, there are some risks in the tax sector called TurboTax, but so far nothing has happened that has significantly affected their sales. However, it's necessary to keep checking related news like this. That's how I would sum it up. Is it a blue chip company? Yes, it is. It scored 86 points and ranks 31st among all listed companies in the United States. That's 0.5%, which is extremely high. Some of you may be hearing about this company for the first time, and you might be surprised that it's ranked this high. Out of about 5,500 companies, it's ranked 32nd, which is incredibly high. And overall, it has a financial stability score of 100, profitability score of 90, cash generation score of 90, and monopoly power score of 100. So these areas are all maxed out, and only the future growth score is 50. But 50 isn't really that low. It's about average growth compared to other companies. So, companies that show this kind of case are typically entering the maturity stage, meaning they've finished their growth phase and are now moving into maturity. This is exactly the type of pattern you see with those companies. So if this pattern is still maintaining a score in the 50s, it means the growth engine is still alive. But if this score drops and appears as a straight line around 10 points, so if this pentagon appears like this and the upper part becomes a straight line and the growth score drops from 10 to 0, you can consider that this company has pretty much entered a stage where growth has stopped. Then it would be a bit difficult to make a long-term investment in this company. It would be better to move your funds to companies that are growing again, or if you see signs or measures that the company is turning around for growth, that would be a good time to invest. So if it's around 50 points right now, that still means it's experiencing moderate growth. If you look at the overall score, it has consistently maintained scores in the 80s for a year, so it's a very good blue chip stock. Companies like this tend to see their stock prices rise significantly over the long term. So let me show you some data from the past 10 years. As you can see, sales, operating profit, and net profit have all steadily increased without any significant fluctuations. They had a strong and excellent business model, and if you look at the operating profit margin, it's 22.2%. In the past, it was even in the high 20% range, so the fact that the operating profit margin has dropped a bit is something we need to pay attention to and keep in mind. This is annual data, and the recent data called Yonan-san is the sum of the most recent 12 months, a trailing value, and this value is 24.3%. So, if you look only at the recent data, the Yonan-san is rising. In other words, the profit margin is turning upward in recent quarters. That's how you should see it. So, for this company, you can interpret it as the profit margin is currently recovering again. Next, I don't usually show the return on equity and price to book ratio charts, but the reason I brought them for this company is that usually the return on equity and price to book ratio indicators move in the same direction. That's just how it has to be. Return on equity moves first, and return on equity also moves according to earnings per share. When return on equity moves, price to book ratio just follows along like a shadow. So when return on equity goes up, price to book ratio goes up, and when return on equity goes down, price to book ratio goes down. But price to book ratio is an investment indicator that we call valuation. So what valuation means is when the stock price that should go down actually drops, and when return on equity goes up, the stock price rises and price to book ratio should also go up. That's the way it works. If you look at this point, as of April 2025, it's like this. So it's probably from January to April in early 2025, right? If you look at this period, return on equity went up. So when return on equity drops like this, then it's right for price to book ratio to drop as well. The price to book ratio, if you look here, return on equity surged, right? It went up like this, but on the other hand, price to book ratio dropped like this. These kinds of cases rarely happen. Normally, it should follow the return on equity. So in the long term, these kinds of moments are actually very good times to invest. Because return on equity, which represents corporate value, goes up, and price to book ratio, which represents the price, goes down. The price has dropped, but the value has increased. When return on equity goes up and price to book ratio goes down, that's actually the best time to invest. That's how you can see it. Actually, I brought a stock price chart from the past year. And if you look at it, there was a sharp drop at this point, which would be around April. When you look at this point, the stock price fell like this. So naturally, The price to book ratio, which compares price to book value, also dropped. Since the price fell, of course the price to book ratio dropped as well. But even though the price to book ratio dropped at this point, profitability was still quite good. But as the market stabilized, the stock price rose rapidly, and especially in the middle, there was an earnings announcement with an earnings surprise which caused a gap up, so the price went up even faster. So it's finding its proper price. If you pay attention to charts like these, it can help you discover good companies. Next, if you look at the cash flow statement, the operating cash flow is above zero here, which means it's positive, and below is negative, so you can see it's steadily growing. So, the operating cash flow is $6.2 billion, investing is minus 1.3, financing is minus 1.3, so plus, minus, minus. This is a typical cash flow pattern of a blue chip company, and it's a very good company. And in the case of net profit, it's currently $3.46 billion, but the operating cash flow is $6.2 billion, which is almost twice as much. So, if the operating cash flow continues like this, there's a good chance that net profit will also grow along with it. Because operating cash flow includes not only net profit, but also things like depreciation and other non-cash expenses that are added or subtracted, that's why the amount for operating cash flow is different. The fact that the operating cash flow is high and there's still a big gap with net profit means that the company already has significant potential for net profit to improve further. That's how we can see it. If you look at the stock price and earnings per share, they're steadily growing, right? As the company grows, the stock price will move along with this growth rate, but the stock price can go up sharply, drop sharply, rise again, and fall again. It can move like this at any time. So when should we buy? Instead of buying when the stock price has surged, it's better to find entry points during corrections like these. Even if you invest in the same company, some people might have very low returns or even negative returns. Because those who bought at this time did see some gains, but their returns would only be this much, right? But those who bought at this point, their returns would be like this. The returns have to be different. So, depending on how well you look at valuation, supply and demand, and timing your trades, even if you invest in the same stock, your returns can be very different. Our Choice Stock app has been released. You can download it from Google or Android or from your iPhone and use it to access the current data and receive our push notifications provided by the app. So you definitely need to enable app push notifications because there will be good promotion opportunities and things like that later on. Since you can receive notifications, don't worry too much because we don't send out random or unnecessary push notifications. If you enable notifications, you'll probably get useful information. If you look at the expected performance, earlier our future growth score was 50 points, right? You saw that earlier, didn't you? With the 5-point scale, we gave it 50 points in the account, meaning this company has average growth. We're checking all this data, so even if you don't look at all of it, if you see 50 points, you can roughly tell how much the company has grown. The sales are $18.7 billion, $21 billion, and then $23.5 billion. If you look at it, that's about 12 to 15% growth. So the sales growth rate is about what you'd expect from a company in a typical mature stage. So it's similar to companies like Microsoft or Google. If you look at the earnings per share, it's 26% this year, which is a bit high, and then 17 and 17, so this company is the same as well. So it's growing at a moderate rate. Based on this level of growth, we set the valuation and decide the timing of our trades. That's the right approach. Just because the stock price has gone up doesn't mean it's a high growth company. That's what it means. So please refer to this graph and let's take a look at the valuation. If you look at this company's valuation and stock price, there aren't really any sharp spikes. It goes up little by little, like steps. Then, the reason it suddenly jumped here is because the company's performance improved significantly, causing its value to jump up. But if you look at the stock price, it moves in line with that pace. So for companies like Intuit, if you buy near or below the fair price, there's a high chance you'll get returns that match the speed at which the company's value increases. That means the investment difficulty is relatively low. If you buy near the fair price, the stock price will eventually rise at the same rate as the earnings per share, or the company's value increases. So that's the kind of case it would be. Next, for the companies I marked in yellow, there were actually 2 times when they fell into the undervalued range like this. In the past year, these points were recorded at even lower prices. Right now, the stock price is here and here. If it drops and hits this level or falls below it here as well, it could be a really good opportunity. So, of course, you have to look at changes in expected earnings. If the earnings drop or come out worse than originally expected and go below this level, it's better to wait. Here, even though the earnings are clearly good and coming out well, the drop happened because of the overall market situation and the market index. So it was much easier to make a judgment. Lastly, if you look at the momentum side around May on the exponential moving average chart, the 5-day line crossed above the 20-day line step by step. In other words, the green line broke through the gray line. After that, you can see that all the lines became aligned in order. At this point, when all 3 lines are aligned in order, from then on, the stock price tends to go into a strong upward trend. On the other hand, as you can see here, they became misaligned. When the green line is below the gray line and then the blue line, it means the downward trend is strong. So even if the valuation is cheap at this time, let's not buy, because we don't know how long it will keep falling. Let's buy when the supply and demand turns around. That's why our trading signals only give a buy signal when the supply and demand turns. Even if the valuation is at rock bottom, the signal doesn't come out unless there's a turn in supply and demand. Only when there's a turn can you wait for a long time. If you buy and the downturn lasts a long time, your funds can get tied up. So rather than trying to buy at the absolute bottom, it might be better to buy a little higher and use your time and investment efficiency more effectively. Now let's move to the website and I'll go over some important points about Intuit. There are a few key things about Intuit, so I'll review those and then wrap things up. If you look at Intuit, the trading signal came out on April 28th, H. The buy signal appeared at $624 on April 28th, H. And since then, it's up about 22.5%. And this was a gap up, but today, rather than focusing on that, let's go into the financials. If you go to the financial chart, you can see the charts I showed earlier as annual or other types. Let me check the quarterly view. What do you think when I click on the quarterly chart? It feels a bit strange, doesn't it? If you look at it like this, the sales spike up sharply and then drop down again. So this is what happens on a quarterly basis. If you look, the 2025 project listed as April 2023 settlement and the 2022 4-year project are really high and sharp. These periods show that this company is heavily affected by seasonal performance. So you shouldn't analyze based on quarterly results. If you analyze with quarterly results, you should use annual or rolling annual figures. Rolling annual means adding up 4 quarters like this. For the previous quarter's rolling annual value, you add them up like this. Then the one sharply peaked quarter will always be included because it's a rolling annual figure, which means it's the sum of the most recent 12 months. That's why rolling annual data helps eliminate the effects of seasonality, and this is what we call trailing data. So for companies with seasonality, it's very important to look at the rolling annual figures. So as I mentioned earlier, this company may look like this on a quarterly basis, but if you look at it on a rolling annual basis, it smooths out and you can't really see those fluctuations. That's why I recommend looking at the data on a rolling annual basis. Next, when I looked at this company's financial statements, another thing that caught my eye was the total assets. If you look here, the total assets are $36.5 billion. But among those, the largest portion is intangible assets. Intangible assets amount to $19 billion. So that's about $20 billion, right? That's incredibly high. It's about 60%, definitely over 50%, and it's close to 60%. So this company put 60% of its assets into intangible assets. Then the question is, how do they make money from intangible assets? Intangible assets are things you spend money on, but they have no physical form. You can't see them. But if you look at this company, they've consistently had intangible assets. There must have been a point in the past when it suddenly spiked. Right now, I'm only looking at the annual data. So if you look here, it was $1.7 billion, then $8.9 billion, and at this point, it jumped up to $20 billion. At that time, there was a huge investment in intangible assets. And as of January 31, 2022, you can see it suddenly spikes. After that, it stays the same, right? It keeps coming in at almost the same value. The reason intangible assets decrease little by little is because of amortization, which gradually reduces their value. It's the same as depreciation, but when you amortize intangible assets, their value goes down little by little. The increase that happened at that point earlier has continued up to now. There are mainly 2 cases where intangible assets jump, but I think you only need to remember the first one. It mainly occurs during M&A. So During mergers and acquisitions, at that time, I know that Intuit acquired a company related to their business. When you make an acquisition, the amount you pay over the book value is recorded as intangible assets. So if you see intangible assets jump in the financial statements, it means there was an M&A. Then you can ask, what kind of M&A did they do? Then, during that period, search for mergers and acquisitions involving this company. If you set the period on search, you might find news articles about the M&A, or maybe you won't. If you want to look further, even if there aren't any articles, you can keep searching. Then go to the Electronic Data Gathering, Analysis and Retrieval Electronic Disclosure System, and for the period when there was a jump, open the financial statements or business reports, like the 10K or 10Q. You know the intangible asset section, right? If you type in the keyword asset on the internet, it'll help you find that section. Then you'll see detailed information about how much a company spent on M&A and how they reflected it in intangible assets. That's how you analyze it. So first, it's usually M&A. Second, sometimes they include development costs, but that's rarely a big amount. So if you see a sudden jump in intangible assets, you can assume it's because of M&A and that the company grew through M&A. That's how you should look at it. Other than that, if you look, most of this company's assets are cash. They have $5.4 billion in cash and cash equivalents and $2 billion in short-term investments. That's $7.4 billion. So this company doesn't have that much in long-term investments. They have about $7.4 billion in cash. They're holding around $7.4 billion in cash. Last time when they made an acquisition, it looks like they spent about $2 billion. They spent about $20 billion, and if you look below, they also have about $7 billion in debt. The debt doesn't seem to be a big deal. In the case of this company, as you can see, they have a lot of cash flow from operating activities, and their free cash flow is close to $6 billion. Because they generate cash flow annually, their cash will continue to accumulate well. If you look here, you can see the speed at which this company accumulates cash. Here, you see April 2025, January, and October. These are 3-month periods. So if you look here, these two combined make up the cash flow, and this is how it goes. It moves like this. There is a possibility that these cash flows will continue to increase. Then, with the increased cash flow, the company could continue to invest. And of course, as you can see above, they would invest in things like R&D expenses or selling and general and A expenses. They will invest, but other than that, for example, if there are situations where they need to do M&A, they can use the increased cash to acquire other companies and grow the company's volume in this way as well. It's a good company with cash flow that has such potential. That's one way to interpret it. And if we take a look at this company's dividends, when it comes to dividends, this company is also one of the attractive dividend stocks. It received 4 out of 5 stars, and the reason is not the dividend yield, but that the dividend itself has been increasing every year. So if you look at it this way, this year the dividend is expected to be around $4.13, and at that rate the dividend yield becomes about 0.5% or higher. So recently, for about 12 consecutive years, the dividend has been steadily increasing, so it's showing a very good trend as a dividend stock. Lastly, let me show you just one more thing. I'd like to give you a tip. When you've analyzed a company like Intuit and found it, sometimes you want to see how this company compares to others, right? Then click here, select Company Overview, and under the overview, you'll see a section called Industry. There's a link here right now. It's linked. So if you click this, it will bring up the industry that Intuit currently belongs to and show it to you. If you look here, earlier we called up only the companies in Technology Category 1, the main category, and Technology Category 2, which is application software. Then here, Intuit is ranked first, Intuit is first, CoreGuard is second, SAP is third, and ServiceNow is fourth. Cadence, Design, Ansys. From these companies, if you want to pick a company with high future growth potential, you can sort them again here. You can sort by market capitalization or other criteria. So here in the sorting options, I want to sort by companies with high growth potential. If you click like this, in the software application sector, a company called Dave has the highest score with 85 points, followed by Minervin with 85 points, Duolingo with 85 points, and Sportradar with 85 points. It's also a very good method to go through them one by one in order and look up each company. I think it will be helpful if you use it this way. With this, we will wrap up today's content on finding stocks about Intuit. If you found this helpful, please subscribe, like, set notifications, and leave a supportive comment. Thank you.